Eric Mother with Mother.com with part 1 of US market analysis for the weekend of November 26th and November 27th, 2016. Take a look at markets here, and we close Friday's session with a nice gain for the markets, all-time highs on a daily closing basis for the S&P 500, for the NASDAQ, and also for the Dow. Let's take a look at those charts. Let's go to the NASDAQ weekly chart, and we can see ever since this bounce with uniform activity below RSI 50 back above it, speculation was that if the market would go to test new highs, and here we are at new highs. So this support on the RSI 50 on the weekly, you can look back and say yes, it did predict that the market would test, if not break through the previous highs. Take a look here at the NASDAQ closing above the previous weekly closing high, and that was at 5,312. So as long as the market is holding above that level, we can say this is a breakaway market with chances of even higher price levels. So anything above this, and you have all the reason in the world to continue being bullish and to play breakouts or momentum names. We can also see that for the NASDAQ, it is moving above the previous monthly closing high. So that's a breakout on the monthly chart. And again, it's the same number of 5,312. As long as the market is above that on a monthly basis, you have to assume the market continues to be one that you have to buy, or assume it will see higher prices. Now, at some point, should we ever break back below that price range, then we would have a reason to be bearish. Right now, the charts look so strong, especially as we can see that on the NASDAQ, it has closed above the previous daily closing high for 2015, and that level was at 5,339.52. So again, as long as the market is breaking out on the daily, breaking out on the weekly, breaking out on the monthly, you have to respect the potential for improved prices. The Dow is working on week number 3. So not only has the Dow broken out already on the weekly chart, it broke out, followed through last week, and now even following through for the 3rd consecutive week. That's a sign of a strong market. And again, as long as the Dow is holding about this price range, even with pullbacks above 18,576.47, which is this weekly closing high here, as long as the market is above that price range, you have to respect the potential for much higher prices. As we pointed out in the last couple of videos, going back to the last weekend edition, we suspected that as long as the Dow was holding above 69.1, we would see an improvement in price highs. That's exactly what we got. Keep in mind, as long as the Dow is above 69.1, expect the market to continue being strong. In other words, the market is going to be stubborn, will not pull back as long as the Dow is holding above 69.1. Keep in mind, this is also true as long as the Dow is holding above 69.1 on its hourly chart. As you can see, it will continue trading well. Same thing can be said on the Dow, because on the Dow 30-minute chart, it closed with its RSI again above 69.1, which is just a measure of strength. As long as the S&P 500 is also breaking out on its weekly chart above the previous weekly closing high, you have to assume that this is going to be a tough market to try and be short. In fact, it only makes sense to be long and ride the wave. So as long as S&P 500 is breaking out above 2184.05, it remains a good market. We take a look at the S&P 500 from a monthly perspective. And again, as long as S&P 500 is holding above the previous monthly closing high, this is a good market to be long and play breakouts. And again, as long as SPX is above 2173.60, continues to be breaking out on the monthly chart, just give it and let it be. Let the market trend and play the trend to the upside. On the daily for the S&P 500, don't expect a pullback as long as the daily continues to hold above 69.1 on the RSI. This market should continue to be stable, if not strong. Now, if one is looking for reasons why the market could pull back, I'll share those reasons with you. Let's begin with the S&P 500 weekly chart. We can see that if you take the top side on a 3-year weekly chart, so 3-year weekly on the S&P 500, you can see signs of the market coming back to test the top side of its weekly RSI. If this becomes resistance, it creates a problem for the market short term. Same thing can be said with the NASDAQ on its 3-year weekly chart. The NASDAQ also is coming back to test the top side of its weekly RSI. As you can see, failure to move above the blue line here and confirmation of resistance might suggest that now the next swing trade could be lower. So we need to watch this resistance line, either for the market to move above that and continue advancing. Otherwise, resistance on this line could suggest the next swing trade would be lower. As we come close to the end of the month of November, we have to be sensitive to the idea that as the month rolls over to December, sometimes things can change. For example, you can see the Dow coming back to test the recent break level off the highs of 2015. So this break in the RSI here brought the market lower, as you can see here. So we draw a line from there. As we begin the new month, late in the week, resistance on this red line could be a problem for the market. As you can see, another reason to be watchful for this is we are seeing an improvement in month-to-month prices, but resistance on this red line would confirm negative divergence with the RSI making a lower high. And the fact that the technicals are not joining the price action could suggest that if we have two of those things developing, so number one would be resistance on this line. If that happens and the market shows resistance here, we would have again negative divergence, improvement in prices month to month, RSI not showing an improvement. That negative divergence could set the stage for a major pullback. In fact, if we take a look at the long-term monthly chart going back the last 20 years or so, we can see that if the market comes back to test this line and fails in the coming month or two or whatever, so if we see confirmation on this red line, it's not a good sign, because if we back test that line, we can see that it coincides very well with the highs of 2000. So the break here brought the market off the highs of 2000 and we went into a major bear market that lasted 2 to 3 years. And again here we see a break in late 2007 that led to the bear market crash of 2008 and early 2009. So the problem here is month to month market needs to be above the red line. Otherwise, we could be running into some type of a problem. Otherwise, as long as the Dow is breaking out on its weekly, as long as the Dow is holding above 69.1 on its daily RSI, even on its hourly, it continues to hold above 69.1. And we can see that the hourly above 69.1 and the 30-minute chart continues to hold above 69. Don't expect there to be a major pullback as long as markets are trading above that RSI threshold. Otherwise, as we go into the new month, let's watch those monthly charts for guidance. Otherwise, subscribers, be on the lookout for part 2 of this weekend's market analysis video. Should be out sometime on Sunday, where I plan to have some fresh ideas for you guys to consider. Enjoy the rest of your weekend. Eric Muadh with Muadh.com. As always, good luck, peace, and blessings. EACS. Mwah.